56% of multifamily loans that are expiring in 2025 are insolvent, according to Newmark. They've got a great new report they're going to be covering today on this episode of the Gray Report. Not only that, CredIQ has a piece out talking about the $40 billion of CRE loan modifications, signaling a shift in the market. How many of those insolvent loans were able to be refinanced, or are we talking about the ones that are in a good position? Also, we had the Fed meeting yesterday. Jerome Powell came out. We're not lowering interest rates. We are staying the course amidst an incredible amount of uncertainty. And then a piece from Cushman & Wakefield talking about multifamily's firm foundation through this next period of volatility. And then from a real page looking at the fact that operators are appearing to be buying occupancy, maintaining higher occupancy levels, but maybe taking the foot off the gas of rent growth. All right, all of that and more. We've got a great episode. Stick around. Let's get into it. Welcome back to The Gray Report, joined again by producer of The Gray Report, Director of Communications and Marketing here at Gray Capital, Dr. Matt Bossnagel. How are we doing, Matt?
It's good to be back. Things change every week.
Yeah.
I think the notes fell in really well. Although that's good news for some, it's good news for us, maybe bad news for some.
Maybe, but it is what it is, trying to make sense of it so we can make some informed decisions. Let's jump right into it. Fed meeting this week.
Yeah.
I was in Michigan up on a site visit. Yes, I didn't watch the meeting live. Maybe I was traveling. It didn't seem like it was that big of a meeting in terms of the press. But you had a different take, Matt. When we sat down today, you were like, I feel like this was maybe a bigger deal than March's.
Yeah.
But you've dug into it a little bit more. You were staying the course.
Attention to it, and that's the reason I brought it up this month rather than the previous uninteresting non-rate cut, is because I think that it's a worthwhile reminder of where the interest rates are. We've been talking a lot about economic uncertainty generally. There's been talk about the bond market generally in terms of like the weakness and strength of the dollar. But it's worth reminding people that interest rates, and I think some people probably don't even need the reminder, but interest rates are still relatively high. They are at an uncomfortable point, I think, for a lot of people, and I don't know if it's called like the clearing rate or something, but the natural settled down interest rate where it should normally be. I think it is about 1% or 2 too high if you had asked me. And I keep thinking back to, 2018, 2019, when the federal funds rate was up to the dizzying heights of like 2.5%.
Yeah.
And we'd love that now. And I don't think that even all of the long-term predictions that I'm seeing, whether it's from Newmark, which we'll get into, or from the Fed themselves in their dot plot, they're saying long-term is we'll get maybe 3.5%, far from the 2%, but still, a worthwhile relief from what we're at right now.
But it's hard to say, right? Because also, in the comments is that they just don't have enough information really to make a call or make a decision on the path of the economy and where inflation is going to go, employment, and therefore what the neutral rate is and where the Fed funds rate should be.
Mm-hmm.
The hard data from the effects of tariffs has not really come into print.
Yeah.
There's a lot of soft data, there's a lot of anecdotes, and there's bits and pieces and conversations, largely because it's still a moving target.
Mm-hmm.
But we haven't had enough time to allow the tariffs to really seep into where the Federal Reserve can empirically say, all right, these are the effects and this is the action that we need to take.
Yeah.
So, it's not surprising that, given that the Fed, the dot plot is relatively, I think, somewhat static from the last meetings, and in the longer run it's relatively elevated.
Mm-hmm.
Because there's just not a clear path.
Yeah.
So it'll be interesting, but to your point, Matt, earlier, maybe not great news for investors, especially in commercial real estate,
mm-hmm.
that are many not used to this higher interest rate environment. And what we've talked about in the past, and I cover it in this Newmark report, is that the math just isn't working for commercial real estate right now, between cap rates and interest rates,
mm-hmm.
short-term and long-term.
Yeah.
Outside of the office sector, where cap rates really have expanded, and Given that there's no meaningful movement lower in interest rates, which was expected last year. If you remember in 2024, there were calls that rates would be significantly lower. This year, there were a lot of calls that the market had really kind of bottomed out last year, and cap rates are maybe going to start to recompress as interest rates are coming down.
I think that some of the activity that was reported in the Newmark report of like sales activity and stuff was almost like momentum from that anticipation of lower rates that we had like late in 2024.
Yeah.
But your point's the same, and that's again it's like the guiding idea that I had in this when I was thinking about interest rates in general is the market is still not in the mindset of like higher for longer, or really there's like this. I don't know if it's like the back of people's heads or like there's just like a lingering unconscious assumption that like rates are going to come down a little bit.
No, I think you're right. I think the base case for most investors and I think economists too is that we still think rates are going to be lower. Now it sounds like a broken record. And the reason for that is, look, we are looking at some slower growth. Negative GDP. GDP grew by minus 0.3 in the first quarter. So we are seeing slower growth. And with slower growth, typically comes lower rates. The challenge, though, is that we're seeing this inflation that is starting to tick up. Now, if you strip housing out, maybe it's actually lower. It depends on how you look at it. Yeah. But the consensus is with these tariffs, maybe it's a transient one-time tick up, but there's going to be some more inflation amidst a period of lower growth, which usually those things too are pretty well correlated. But if we're seeing lower growth, which we are seeing lower rent growth right now coming into the numbers, not negative, but lower in April than it was last April, and was I think a little bit of a disappointment to some folks. We're seeing lower growth, but expenses are still somewhat elevated. All these material costs cost more. Wages might bump up a little bit more. So you're not getting the growth from net operating income, but interest rates are still too high. Therefore, if you're looking to transact, the math doesn't make sense if you're talking about a sub 5% cap rate, but your cost of debt capital is closer to 6%.
Yeah, the numbers aren't working, and there's like the numbers of the deals in general. Like a lot of the buyers are probably the most realistic. They're sitting it out. The prices don't make sense, but the sellers are keeping their prices at a price that assumes that maybe rates are going to be a little bit better. And so so there isn't this harsh realization of like, all right, if things are going to move, and sales are better than they used to be, but they're still not where they should be or where it was normal, like kind of pre-pandemic. So this sluggishness, I think, is a market that's operating outside of the conditions that we're currently facing. And all of this, and that's why I kind of wanted to bring back this idea of interest rates. It's like, well, they're not going down anytime soon. And arguably, if you look at the chart, the past 5 years have been like the longest increase in the 10-year treasury since like early 1980s. So since like 1981, the general trend for the 10-year treasury has been going down. And interest rates since like 2020, when they bottomed out, 10-year treasury at least, they have been going up for the past 5 years. And that 5 years is the longest length of time for interest rates to be increasing. It looks like we're in kind of a different paradigm.
Yeah.
I'm waiting. I really would love for things to kind of get back to a normal, but it does look like maybe the rules are going to be changing. And my thought is, going into the notes and thinking about Jerome Powell a little bit, is does the CRE market, do transactions start to factor in different rules, or is it going to still kind of operate under the assumption that things are going to go back to whatever they think normal is?
It's almost like it's a staring contest, buyers and sellers, and it's like who's going to blink first. Who's going to because buyers are motivated to transact, especially institutions, private equity, that the business is driven by doing deals. So if you don't do deals, your business doesn't grow, and you're typically not bringing in revenue. So there's a desire to do deals, but you have to do good deals, right? You can't just like throw good money after bad. And so in looking at the long-term fundamentals, we're going to get into more and we talk about every week. Long-term things look pretty good in terms of supply coming down, rent growth in the future, the rent versus buy calculation. Long-term fundamentals for multifamily look solid.
Yeah.
But so how much are you willing to pay up for that, good couple of years in the future today?
Yeah.
And they have to be pretty damn good though in the future to make up for the price you're going to pay today.
Yeah.
And you can't say, well, yeah, the fundamentals will be good tomorrow. That doesn't mean you can just pay any price and it will work out.
Yeah, and if you want to look at shattered dreams, you can look at at the loan modifications and the extended pretend and the people that are really maybe underwater, or at least struggling a lot more with their loans than they thought they would when, even 3 years ago.
Yeah, well, and that's the other side of it. That on the seller side is you have some folks that are like that have deals that are insolvent and they don't make sense.
Yeah.
But, they've had brokers probably tell them somewhat recently that their deals may still be worth enough for them to get out without losing money.
Yeah.
I think that narrative is changing a little bit today because, again, rates are still higher. They haven't come down, and you don't want to cry wolf too many times. It's like it is what it is. We are where we are, and until things change, this is the present. This is the information we have to act on.
Yeah, yeah.
So there'll be some buyers, which we've already seen, that have said, okay, yeah, I'll pay the high price, the low cap rate, because I need to do a deal. Those are going to be relatively skinny deals. Some of them are I've seen being acquired in really good locations, good demographics, and they probably won't lose money on the deals. They're just the returns are going to be pretty low. The cash flow is going to be almost non-existent for the first couple of years, and the idea that I think is pretty likely that over the next 10 years we do see interest rates come down. You're going to see some rent growth over that period, and you'll be able to sell it for more than what you purchased it at today. Especially because even if the returns are low, the basis, like the acquisition basis relative to what it takes to build those properties, seems attractive. If you can buy it for less than you can build it, like that's a favorable proposition. But at the end of the day, we're not living in a labor theory of value world where it's like, well, it costs this much to build it, therefore it's going to be worth more. The way that commercial real estate is valued, including multifamily, is how much income does it produce.
Yeah.
And then there's a cap rate valuation based on that. So at the end of the day, it's got to be producing cash flow, it's got to be producing income to get a return, to put a value on it.
Yeah.
And that's where investors like Great Capital, when we're looking at the numbers, it's like, okay, yeah, I can buy this for less than I can build it, but then what?
Yeah.
The goal isn't to buy something less than you can build it. The goal often is to produce a return that's above the market average, to deliver a really great living experience for your residents. So it doesn't really matter, like your basis, if it turns into a great experience, if the basis turns into high returns, awesome, and it can, but the basis isn't enough to make it a good deal.
Yep.
If that makes sense.
Well, you could be buying an older property that needs work compared to a new build. If it's below replacement cost, but you need to pour a lot more money into it, then that's
exactly.
A challenge.
Well, and we're seeing a lot of that today of deals that are newer or newish deals that are being sold at market as, you can buy it under replacement costs, but let's say it's a early 2000s vintage deal, so it's like newer, but it's still 20 years old now.
Yeah.
So it's going to need some work, and so they're saying, well, you can't build it for that. They're trying to sell it for called $210 a door, and they're saying, you couldn't deliver this for less than $215, $220, which may or may not be the case. Yeah. Probably will be as tariffs keep seeping into the system. But if you have to put in $10,000 or $20,000 per unit into the deal, then you're basically at the cost of new construction, but you still have a 20-year-old property. You're going to be able to fix some of it. You're going to be able to fix some of the units. You're going to be able to paint some of the buildings. You're going to be able to fix some of the curb appeal, but it's still going to be a 20-year-old building. It's not going to be a brand new 2025 delivered product.
Yeah.
You have to build them differently. Still attractive, still demand for that 2000s product. I actually think it's a awesome sweet spot if you can buy it right, but it's not, but you have to make sure you're comparing apples to apples, and the returns have to make sense. Let's jump into this Newmark report, Matt.
Let's do it.
Okay. Really thought this was good, and this is starting what we teased the show into, and this is some loans. This is breaking down loans of different commercial real estate asset classes, including multifamily. And we're looking at the DSCR, the debt service coverage ratio profile. What that means is your debt service coverage ratio is how much money are you making, before you can not pay your mortgage. And so if you can only make enough money to pay your mortgage, you have a DSCR of 1. A DSCR below 1 means you're not making enough money at the property to pay your mortgage. So you want to be above 1, and typically lenders like to see a ratio of like 1.8 to 1.3 to even give you a loan initially. So 56% of multifamily outstanding securitized CRE debt, now specifically multifamily, 56% or 43.6 billion has a DSCR below 1, or defined as insolvent. 17% is classified as higher risk with a DSCR less than 1.25. Some of those might be okay. And then about 30% is in between a DSCR of that 1.25 and above 2. So, call it, $17 billion is in a pretty safe spot.
Yeah.
So, what we're thinking of is, in one of the new pieces of information on the report, is the idea that the amount of loan originations are up in Q1, which was really interesting because sales activity is still really low. Let me see if I can.
Be above that.
Okay, yeah, this report is a little bit all over the place, but the sales activity. And we're going to come back to a lot of this. There's so much good information in this report. You can go to greatcapitalllc.com/newsletter. You can sign up for the Great Capital newsletter and get these reports sent to you every single week. So sales activity, while it's a little bit up from last year, it's well below kind of pre-pandemic levels. But debt originations have really started to skyrocket. I'm just going to pop over here because I had to wonder, okay, if sales transactions are relatively muted, but there's a ton of debt originations, it has to be refinances, and we are seeing quite a bit of loans refinanced and modified. This report from Credit IQ, before we jump back to the Newmark report, shows a huge surge in loan modifications that took place in January 2025, the second highest really since July of 23, which is when rates started rising and people knew that they had to get out some of those deals, which was when we put out, just prior to this, we put out the first loan maturities report. And everyone read the report and we're like, okay, we've got to modify our loans. So, we're in an environment where people are realizing they have to take some action, whether get their loan modified or if they look at being able to refinance. Some of those are able to refinance by the performance of their property. Some of those properties are going to have to actually bring cash into the deal itself. And those that aren't able to bring cash into the deal or can't refinance based on their financials, the question is what's going to happen. Can they get that extra modification? Which it looks like modifications are continuing to happen. We've talked a lot about, extended pretend is coming to an end. Clearly, it has not.
Yeah, well, and we'll learn, when we get to the Credit IQ, again, that extended pretend is only growing. And I think that there are, we could broaden the definition of extended pretend beyond specific bank modifications. There's things like private credit, there's debt funds, there's calling back your investors and asking for more money and making a capital call. There's lots of options. If you get down to there's lots of options between the rock and the hard place before you have to sell it outright for less than you want to.
True.
And I think that's what we'll probably be seeing is other layers. So, ideally, you get a layer of, you get the money from the bank at a good loan, and then you get really nice investors, and then that's it. But now they're going to, maybe, the bank loan gets really expensive, so you have to add, maybe it's a capital call, or maybe it's another thing of private credit or other debt that you're getting from someone else at a higher rate. It gets more burdensome, but it gets you over this maybe what you might think is temporary. Again, it's this question of, are people going to maybe be reasonable and cut and run, or are they going to kind of compound their problems? And are these people, whether they're debt funds or whether they are private credit or banks, or are they going to be, or the investors themselves in capital calls, are they going to say this is a good idea, I'm going to give it more money? Or are they going to say, well, this is a Class C apartment building that you haven't even done the value add yet in Austin, and there has been negative 6% rent growth. I don't see a way out, so I'm not going to give you more money. That could happen, and I don't think that that's impossible at all, especially considering that rates maybe they're higher forever. Who
Yeah.
knows?
And what's difficult to quantify is it's not going to be one of those for everyone. It's going to be all of that and more.
Yeah.
Because every property is different. Every loan, every situation is different, and there's going to be a wide spectrum of outcomes. It's just so it's where is going to be the concentration of those outcomes. How many of those deals will be unsuccessful to make a capital call or to refinance, and then what? Is a modification able to take place because the bank doesn't want to take it back, or is it surrendered back to the bank, or is it fire saled at a low price? I mean, and that's the question that most investors have is, where are we going on pricing? We've talked about good long-term fundamentals. There's been some transaction activity at still higher pricing, but at some point, there has to be a buyer on the other end that's willing to take these properties for a price where the returns make sense.
Yeah.
And while there are enough institutional buyers out there that are picking up some of the deals that have to be sold at relatively high prices, there's only so much of that capital available.
Yeah.
In the Newmark report, it highlights that dry powder amongst real estate private equity is down. It's been down basically since 2022. And a lot of the dry powder that still is out there is from older funds that still just have money that they need to deploy because they weren't able to deploy over the last couple of years because they couldn't find deals.
They're all in this opportunistic category that I always raise my eyebrow. It's like, what is the opportunity that you're looking for?
Good ones.
Yeah, because it does give me the idea that is all of this dry powder, are all of these investors just waiting to pounce at like this perfect deal that I just described, the owner in Austin that has to sell for really cheap. Well, we're going to be there. It's going to happen. Or is it going to be like what I think is a lot more slower wave? Whatever's going to happen is going to be a little more gradual, and you just have to keep your eye out for something that makes sense in the moment rather than like wait for something that dramatically looks perfect for you.
Yeah, I think that everyone wants that like inflection point of, some announcement that, all right, a Class A deal is now being... They're all going for a 5.5 cap.
Yeah.
No longer a 5 cap or below. It's 5.5. And you know what, guys? For B class, it's going to be a 6 cap. And C, it's going to be 6. It's going to be 6.5 cap.
Yeah.
Obviously, it's never that like cut and dry and easy. But like we just need some price discovery to give us a little bit of direction.
Yeah. No, and I think that when you're talking about risk, like we're talking cap rates and risk, I think that's an important context as well, is like risk and return. If higher cap rates for higher risk, this is a higher risk environment economically, and I think that may still be reflected, and there may still be room to move. And I just want to quote here. This includes all CRE, but here's the quote from Newmark: "Office spread is 74th percentile relative to history, apartment 18th, industrial 28th, and strip center 36. Investors need to ask themselves, is this asset class really less risky than it has been except for X percent of the time?
Yeah.
That's what accepting these spreads signifies. This is coherent if long-term rates fall significantly, or if credit spreads fall materially, or if NOI growth is materially higher. Other than that, like, investors have got to accept lower returns."
Yeah, and so you can think about it a couple different ways. I mean, I can make the argument that, you are getting lower returns because the risk is relatively low. You go buy a new deal in a great location with trending demographics, including rent growth, like in the suburbs.
Yep.
You go buy that deal. Like, again, if you hold over 10 years, like the risk of losing the deal, you put in fixed rate debt that, that the current numbers can support.
Yeah.
If it covers that mortgage payment, you're not going to lose money. The risk is probably relatively low. So I think that's one way you can think about it.
I wonder, that just made me think really quickly. I wonder if the ones that are coming to sale are the nicer ones. The ones that are riskier, the ones that are value add, the ones that people know, like, I can't sell this. Or they're holding on to it. And it's making the market kind of a little bit out of whack, not really representative of what could be sold.
It's true. I mean, the older stuff, some of it's on the market, but it's not trading. The newer stuff, not all of it's trading it, but some of, at least that's the stuff that is trading. But also your point, it was interesting on just on risk and in return. Another argument that easily could be made is that, we're in more of an environment that favors speculation and growth investors. Typically if you go to your wealth manager, they're going to say, basically try to put you in a category or a spectrum between income and growth. Are you trying to grow your net worth, or are you looking to produce income? And typically when you're younger, you're looking for growth. You've got time, and so you can accept more risk. Higher growth means higher return, which means you need to take more risk to be able to achieve that growth.
Yeah.
Income typically comes with lower growth prospects, so more cash flow, but typically relatively lower risk. You might not make a ton of money, but you're going to make some money.
Yeah.
The simplest example is bonds. You clip a coupon, no upside. Stocks, maybe no coupon, but maybe you're going to triple your money.
Yeah.
We're in an environment where it is the thesis for investing is speculative. It's less anchored in the reality of today, as in today the properties don't cash flow. So if you're a cash flow investor, which most, not all, but many real estate investors are cash flow investors. The reason why they get into it is for cash flow. Not all of them, but cash flow is a huge component of why you invest in real estate. And so now if you've taken that benefit of cash flow, and it's like, well, that's not really there right now.
Yeah.
But there's some big opportunities for upside. And you can speculate in the future. Most real estate investors look at that and they're like, no, I'm not really into doing that much speculating.
Yeah.
Like the only speculating that we're doing in multifamily is, yeah, I'm going to do some work and I think that I can grow rents a little bit over the year, but the property's already producing cash flow and I'm going to speculate I'm going to make a little bit more cash flow.
Yeah.
Not that we're going to make more in rent, rates are going to come down, cap rates are going to come down, supply is going to do Y, and
we're going to find oil on the property.
We're going to find exactly, and therefore we're going to produce 2 or 3x.
That's one of the things that's like this thought in the back of people's minds that things are going to get better. It's whether it is interest rates or whether it's an up and coming neighborhood. There does just seem to be an element of the good days are right around the corner. I'm going to wait till 2026, and I'm pricing that into 2025, and I'm kind of ignoring all the pain that needs to happen to get there.
And things will get better.
Yeah.
Like I do believe that, but just when will they get better?
Yeah.
And how much are you willing to speculate and bet that? Because to make some of those calls, you have to really pay up and go a couple of years with little to no cash flow to buy one of those Class A big Class A deals in a really fast growing submarket. You have to overpay and be confident that this thing's not going anywhere, which it probably isn't. But then you've got to write like a call it $45-50 million check if you want to do one of these deals. And it's not like we're in an environment of where there is overabundance of equity out there. So that further limits the buyer pool and the appetite. And so something has to give. And you started at the beginning of the show of are we in a new paradigm? And we are in a new paradigm. It's going to probably rhyme with previous paradigms, but we've known that something has got to give here.
For the past 2 years.
It doesn't make sense. And I think we all were just hoping, or many were hoping in the industry, that this is just short-lived, this is transient, rates are going to spike up and they're going to spike back down, and we can kind of put our heads in the sand for 2 years, and when we pop them back up, values will be right where they were, rates will be back to where they were, all will be good, and we can just ignore the last 2 years and keep on moving. I don't know if we'll have that luxury.
Me neither. It did seem like, in the early moments of the plateau in high interest rates, that people were talking about higher for longer a lot more than now when it has been higher for longer. And people are seeing the light at the end of the tunnel a little bit more. And it's going to be really interesting because looking at these projections, and I thought this was particularly interesting for me.
This is just what you were talking about, basically. What the
number
narrative.
one projection is kind of the worst case scenario for interest rates, which is stagflation, stubborn inflation growth and low growth. They're talking about Fed funds maybe 3.75 to 4.5 at the end of the year. 10-year Treasury about the same. So we're getting close 4.5-5% interest rates by the end of the year. That's higher than they are right now. So no relief is kind of what I'm trying to say, and I'm just surprised. Maybe I shouldn't be surprised because commercial real estate is slow to react. And just the timeline for a deal means that pricing is going to have a little bit of a lag behind market conditions. But it's been 2 years, and there still is like the assumption that things are going to go back to normal if we just hold on for one more day.
Yeah. Yeah.
But
yeah. It's gonna
maybe some are hold on for one more day. Maybe some are losing their grip. I don't know.
Only time will tell. But we're going through some of these graphs, and again, things are looking a little bit different. It's just not typical that you're seeing bank debt originations. Again, going back to what we kind of started with, these bank originations up 42%. Well above that. Above originations in 17 and 19, but as we looked at that other chart, the sales activity is way below 17 to 19. So we know refinances are taking place. Some people are able to live the fight another day, but there is a strong sense that we have to kind of do a little bit of a reset on the market.
And that's what's really frustrating too is that, and you can see it elsewhere in this in this report, is it does seem like finally after this sluggishness of like more than 2 years really from all commercial real estate sectors, that things were maybe looking to turn around. Even office returns were like turning positive for the first time in forever. And we had this momentum equally in the multifamily market, but things have just been thrown into a little bit of chaos now, and we don't know what to accept. I'm a little bit chastened, given the relatively poor performance of commercial real estate in the past couple of years. It makes me a little less optimistic that it's that things are going to improve dramatically in 2025.
Yeah, I'm on the same page. I think that we've all been a little impatient, just because I think that we don't want to believe that
earned it.
It's like, all right, we've been through it long enough, and when we kind of got a sense of exactly this back in 2023, just like when COVID started in the pandemic, everyone wanted to be over. It's like, all right, can we just stop this spread and then get back? It's like, it's going to take 2 weeks. All right, then we're going to get back to it. And then like, what do you mean it's longer? What do you mean? What do you mean we haven't ended the global pandemic in 3 weeks? Like, well, that's great. Well, come on. And we're the same way here. It's like we kind of like shut down and restarted the entire global economy. We spent, created more dollars than had ever been created, before. Incredible amount of inflation, resetting, global trade, and we're like, can't things just be the same?
Yeah.
Like, we can want that, but what in what world and universe, would they be?
Yeah.
Again, I think things are in cycles, and things rhyme, and things do turn around. Just those cycles can take longer. Yeah. And I'm going to come back to the concept, Matt, that we've talked about really since 2022, 2023. This idea of it's like kind of time dilation and compression, in that we had almost a decade's worth of growth in like a 1.5 year period. Yeah. And we've given some of that back, but just like as that time like compresses, now it's like the refraction period.
Yeah.
And it could be, I'm just saying, just if all things equal, if all there's like a return to the mean, this period of like retracement is stretched out and is a little bit longer than we're used to, or we want to for it to be, or that a level that we're comfortable, because it is uncomfortable.
And that's a good point too. Like if you're looking at the multifamily market specifically, it's been stagnant, and it may heat up a little bit. We will get past 2025, and we will be facing a relative shortage of new apartment building.
Yeah.
So things will maybe fall into line a little bit better balance between supply and demand, where rent growth is about the same as it was, or maybe higher than historical norms. But I think that there's going to be a swing, and 2025 is going to be that transitionary period.
Yeah.
It'll be chaotic. It'll be shaky. I think that a lot of markets are going to be wildly different, and we'll see this in the RealPage report. Like the Sun Belt and the South and the West, those markets in general are not doing as well as the Midwest and Northeast. This may be a year where you can find actually I don't want to say sanctuary, but maybe a very strong growing apartment investment in the Midwest, in the Northeast. You have to look at the right markets, probably the right neighborhoods, and you have to assume that 2025 still is not going to be without its challenges, no matter where you are.
But then you could also say that, hey, the Sun Belt, if someone's willing to sell me a deal at a high cap rate, okay, your rents are going to be negative this year, maybe even a little bit in 2026, but The population growth is there. If I can get the low basis and I can speculate that the growth will return, could be some interesting opportunities.
Yeah.
It's just it's the do you want to play the catch a falling knife game at that point?
That'll be super interesting to see how the markets, how sales in Austin may reflect sales in Boston.
Yeah.
You know?
Yeah.
And if there
Yeah.
is like because right now with relatively few things coming on the market, there's a price setting that could occur should like a worst case scenario happen and these maturities.
And that's where you got to be the widest bid ask spread, because you've got buyers who are like, oh, I'd love to buy in Nashville at a discount. Buy that 6 cap or Austin. I'm going to buy that 6 cap in Austin. Or 7 cap in Austin, but you've got the seller who is like, no, my underwriting, I was going to sell it at a 4 cap, and that's with a positive trended net operating income. I've had my NOI go down, and I still want to sell it at now to get to my returns. I have to sell it at like a 3 cap, and so that spread is just so wide, and that owner, unless they're really forced to transact, like why would they want to again peek their head out of the dirt or the sand? Whereas in the Midwest or in the Northeast, you've got some owners where the value is where they can a level that they can transact. So I think it will be interesting to watch transaction volumes, and there will be more deals done in the Midwest and the Northeast than are done in the South and Sun Belt for sure.
Yeah, super interesting. It's not watch this space. I keep saying that. I think that it'll be. It's not going away. Loan maturities aren't going away, and especially if you're expanding your scope from like 2025 to 2027 and really looking for a gradual wave rather than like a sharp wall, you may see this have an effect on the market.
Yeah. I agree, Matt. Anything in addition you want to mention on the Cred IQ report? We were looking at this. We talked about the huge growth in loan modifications.
Yeah, just this chart.
Yeah,
and how it shows. This is the cumulative modifications from January 2022 to March 2025, and you see a sharp, not just an incline, but like an accelerating incline. And that's what I wanted to draw attention to is how modifications have been growing cumulatively, but the rate of their growth is increasing as time is passing, and that to me means that more people are modifying greater values of loans. You combine this with the information from Newmark, and there's a compelling case to be made that people are trying to wriggle out of bad of like unworkable, maybe of very uncomfortable situations.
Yeah.
Some are succeeding, and I bet more succeed than we think. But
what's frustrating about this, again, between looking at the refinance numbers and the modifications, are we just kicking the can further down the road? Because what I think that we have been longing for is some sort of not a absolute inflection point, but at least progress towards enough volume of where we can have some clarity in terms of like price discovery. And if we are modifying so much, I mean, we've modified over $40 billion of loans, and we've just modified, doesn't give us the value, but we just between January and March, we've modified more than 375
like
actual loans, which again, I don't know how exactly that much is, but we've refinanced a lot. One example that CredIQ makes it in a real life case study is, so I'll just read it. A standout example of this trend is the iconic Willis Tower, a 3.8 million square foot office tower in Chicago's West Loop. It was backed by a $1.3 billion loan, interest only. Loan was originally set to mature in March of 2020. So this is a 2020 maturity with 5 one-year extension options. So
obviously, do you think they took those extension options?
Well, obviously, yeah. Well, it's 2025. So in March 2025, the loan was modified, pushing the maturity date to 2028. So they already exercised their so like the extensions aren't the modification. The extension is what you already get. That's what you agreed upon in the original loan.
Well, okay.
And so the modification was after the extensions expired, they were able to get an additional 3 years of extensions. And so now it's going to mature in 2028. And so, again...
Well, my point is like the 1 year extension options, is that standard practice? Like you're just tacking on 5 years, you're going to take it no matter what? Or is it like, all right, here's another year. They're already that. What
No,
I
this
learned
was
that was like they're extending and pretending at in those 5
this
years.
is not extending. These are not extend. This is not extending and pretending.
That's more like that's okay.
No,
okay.
that's standard in your
Okay.
loan. You have a built-in extension.
Okay.
The extending and pretending is we have to pretend. Is the whole pretending part? It's like
Yeah.
the loan doesn't work anymore. Now I have to pretend that it does to give you an
you
extension.
gotta have a little
Because if I really knew, if we all called it like it really is, we ain't going to give you any more time or money. We're just going to take the property back.
Okay.
But we don't want to deal with that now, so we're going to give you some extra time. And not just that, they didn't just give them a year; they give them 3 years. Now, there's nothing kind of normal about a $1.3 billion loan.
So this is a more of a bank problem kind of thing, right? If you have a loan that big.
Exactly. This is definitely the bank. The bank. This is everybody's got a problem, but it's certainly a problem
That's a really good
at the
point.
bank. And so it says that underwriting in February 18, when I think the purchase was originated, the property was appraised at 1.78 billion. As of the latest data, it maintains an occupancy rate of 83% and debt service coverage of 1.32. So, the reason why they were able to modify this loan is because it is actually performing.
Okay.
So in their case, like you're paying your mortgage, sounds good. We'll give you an extra time because in this scenario, again, they don't want the 1.3 billion dollars back. They're getting paid on it.
Yeah.
They don't to deal with the property. This is a client that they don't want. I mean, it's the Willis Tower. We're talking about the Sears Tower here. They don't want to. They want that buyer to go buy another $1 billion property and give them a loan.
Yeah.
So why ruin that relationship if they don't have to? But there are many cases in the multifamily where that DSCR was not positive or it was below 1, and they're still giving. That's the true pretending of like we're going to pretend like it's okay when it's really not okay because we just both don't want to deal with it.
Yeah. That's interesting, and I also think it illustrates that like a lot of these loans are in office, but and Newmark mentions it. Multifamily is a sizable chunk of these loans as well.
In the larger percentage of maturities, larger percentage of multifamily are insolvent than office.
Okay. Wow.
Yeah.
Yeah. That's really interesting. It is. I think it's increasingly relevant too. And there's another Credit IQ piece of data that we covered about a month ago that talked about rising delinquencies. And these delinquencies are following roughly the same kind of accelerating path that we saw related to loan modifications. This is not a wall that happened and we got over it 2 years ago. We said that there was a low maturity wave in 2023. Well, actually, that was maybe the beginning of a wave. And now it's just still increasing, still a factor.
Trying to flatten the curve. I mean, that's what's going on right now. It's that it was a kind of a peak, and they're trying to get the peak down, spread it out, so the market can absorb it piece by piece, and maybe it's not as bad, as deep as it could be if it's stretched out. But the problem with that is that we can't like clear the market and restart the market and have the market working. The market isn't really working as it is intended, whatever that means.
And to kind of go back to why this is worth mentioning now, you go back to Jerome Powell. He's keeping rates, or the Federal Reserve is keeping rates elevated. This is all a kind of a product of the persistent elevated rates. Yep. And once rates get down to where people are comfortable transacting, then that might go away. But either the rates change or the way we transact change, or there's going to be some kind of crisis or like discomfort, let's just say, in the middle, and maybe even distress. So that's why I think that it is worth watching. It's worth watching because rates haven't changed, which fueled the thing to begin with. Once rates get down, then maybe I'll stop talking about it. But I think it's still worth talking about now. Loan maturities and distress and
I agree. At some point, like reality, the chickens are going to come home to roost.
Yeah.
And we're going to face reality. But perception is also reality. So the way we all perceive it. And
if you're really good at pretending, maybe you can convince a lot of other people to pretend along with you. And
life's a stage.
I guess it's true. You are who you pretend to be.
Yep. All right. RealPage analytics blog. Operators appear to buy occupancy as rent growth slows in April. Again, this lines up with some of the anecdotal that we've seen. we're in leasing season. April is often kind of like the first month of the start of leasing season.
Yeah.
Exciting time, signing new leases. Got to get it in before kind of August. Kids go back to school.
Mm-hmm.
And good news, occupancy is up, climbing 40 basis points and averaging 95.7% in April. Good to hear. People are moving in. That also makes sense. We're getting reports that renewal rates are higher. People are wanting to stay put, probably because of economic uncertainty.
Yeah.
I don't want to have to go and maybe pay rent. I don't want to deal with the process of moving. Just give me some stability in my life right now.
And on the operator side, it's heads in beds. Is that the phrase that people say?
Yeah.
So you keep the heads in the beds. It's better that than no heads in beds, and then you're essentially paying for an empty room.
Especially if you're not getting the rent growth or you're not confident that you're getting the rent growth.
Yeah.
And what seems to be happening is people are getting a little bit, but there's a limit.
Mm-hmm.
People are not willing to pay whatever for an apartment because there's still a decent amount of supply, but people aren't necessarily buying homes. They can't afford to buy homes.
Mm-hmm.
So renting is the option, but not everyone's looking to just buy the most expensive place. So people have a budget. They're looking for something. Once they get it locked in, they're typically now staying a little bit longer than just a year on average.
The algorithm's doing this?
Doing what?
Doing the
lowering the rents or not growing
RealPage
rent
is
as fast?
reporting. RealPage
It's true.
said that in March, the rent growth from RealPage was 1.1% national average. Now it is 1%. It's lower. Can we thank the algorithm?
I think so. I think so.
You know what it is? It's AI. You know how ChatGPT made AI overly obsequious and they had to edit it down? That's maybe it's nice.
I didn't experience
it's a nice AI.
I wasn't experiencing the over coddling. I saw some of the memes and videos. Maybe I'm asking it different questions. I'm like
yesterday I was having a critique a report I'm working on, and it was like, and I had some honest critique, and I wanted to say respectfully, you can pound sand.
Can you be a little bit more critical? I don't want you just to affirm whatever. So breaking down the occupancy by region, we see that Northeast is booking a really strong occupancy, almost 97%. The Midwest just a little bit behind. Both are punching above their longer term averages.
Notably, the Midwest, this is the first time in over a year where national occupancy has exceeded Midwest occupancy. So I just wanted to note that.
Yeah. But typically, and we had this conversation a week or two ago, the Midwest often is like, especially like markets like Indianapolis, not necessarily at 95%. It's kind of like always hanging at like 93 or 94. So this is pretty high.
Regionally, and this is one thing I really do appreciate about RealPage, and that they do and that no other place has done in the same way, is they look at the regions. I think it's useful to look at how the Midwest, Northeast, South, and West, these are the census regions, are performing relative to each other. And for over a year, Midwest's rent growth has been better. Midwest rent growth is almost 4 times the national average. It's at 3.6% compared to the 1% national average.
It really just goes to show that the lack of importance, I guess, of some of the national averages. I'm not saying it's not important as general direction and kind of from a macro analysis, but I mean, you would to say that there was rent growth of 1%. That doesn't really mean much when in reality that it grew by above average 3.6% in the Midwest, 3.3 in the Northeast, but you're negative in the South and 0.5 in the West.
Yeah, it's completely different worlds of rent growth.
Completely different. I mean, you're literally sucking wind, or you're actually making some good progress. And so if you just the apartments are up by 1%, it doesn't really tell you a whole lot.
And that's what I was saying before is I think 2025, part of the volatility that the market will see is this huge divergence of between markets, really between regions. I think would be a useful thing. If you're looking at markets, you can look in the general Midwest area. You're going to find a lot more success than if you look at the Sun Belt.
Yeah.
And you can see it here in these markets with the deepest rent cuts.
Yeah, markets with deepest rent cuts. Year ending April 2025. A lot of these are pretty familiar to a lot of us now. The market with the deepest rent cut is Austin, negative 6.9%. Again, these are just compounding negative numbers. It's not like this is total rents have gone down 6.9%. And you had buyers that were projecting double-digit rent growth for multiple years with exit caps of 4%.
I see that 6.9%, yes, as bad 2025. I also see it in the next 3 or 4 years. How long is it going to take to go from negative 6.9 to like a positive 3.
You're-
That's especially with their construction is not going to vanish overnight. So that market's got years before it comes back into.
I don't know. I haven't done enough my own analysis. I don't know if it has years of negative growth or not. I think it has some. It definitely has some more short-term headwinds. But mark my words, I think in medium term, you will see double-digit rent growth in Austin, but it's going to be a base effect because rents have come down so much that it'll still be negative relative to the peak. But I mean, you're going to see some significant just base effects because of how far Austin and many Sunbelt markets. So don't be surprised in 2026. The Sunbelt will probably retake the leaderboard in terms of rent growth because the Midwest is going to be stable and could be growing at 3 or 4 or 5%, but the Sunbelt is going to be cranking at 10%. But you have to look at the cumulative growth over time, and that's where the Midwest has always shined. Is that you don't always see the extreme booms. You see really solid growth, but you see there's just an absence of the loss and the declines, and so you're just able to steadily compound rather than shoot up and then shoot down, overcorrect and oversupply. And it's the simple, the tortoise and the hare, and the tortoise winning the race.
And some of these Midwest markets too they enjoy a lot of the benefits without a lot of the drawbacks. And it is just worth noting all these markets with the deepest rent cuts, they are all in either the South or the West. Austin, Phoenix, Denver, Atlanta, San Antonio, Nashville, Jacksonville, Salt Lake City, Fort Worth, Dallas. Dallas at negative 2.2%. That's like the number 10, and then obviously that negative 7% for Austin. And then the flip side for all of the rent growth leaders, only 2, San Jose and Richmond, are like Sunbelt or West, or the West
San
and the
Francisco.
South. Oh, I'm sorry. There's 3. There's San Francisco, San Jose, and Richmond are the only ones that are outside like the Northeast or the Midwest. A big Midwest presence in these top 10 rent growth leaders. Chicago is very surprising, 5.4% rent growth. Kansas City not far behind at 4.8%. Cincinnati, New York, Washington D.C., Columbus, Milwaukee, Pittsburgh. A lot of Midwest markets. I know Indianapolis is in there. Maybe it's on number 11, but they're all doing really well, and there's a good reason for that too. And I just finished writing a report on it. It's the supply. Supply's a lot more manageable. Supply didn't peak in the ways it peaked in the Sunbelt, and therefore the historic generation wave of new construction that was happening in 2022 to 2024, that wave is receding in the Midwest maybe a little bit sooner, and getting back to normal in the Midwest.
And it just wasn't as big of a wave also.
Yeah. So a lot more manageable, a lot more predictable, and arguably, and just kind of to note, another article that we won't cover here talked about how multifamily is well situated for these volatile periods, and I think that you referenced it too. And we were talking beforehand. You think about, well, let's compare it to retail assets. Well, retail's going to be hit maybe by tariffs if the shelves are empty. Industrial probably hit by tariffs if they can't get the parts in. And it's this Cushman and Wakefield that talks about how multifamily is maybe one of the more defensive asset classes during these volatile periods. I think there's a good case to be made, even though it's shaky on the multifamily side, like relative or like if you
short term,
compared to other real estate asset classes, and probably compared to the stock market, you're in a pretty good spot with multifamily. Yeah,
I'm hearing that more and more from non-traditional like multifamily investors, maybe people who have invested, but it's like not their full time and that's the only asset class they talk about. More interest on the real assets, specifically, cash producing multifamily properties, just because the long-term nature makes a lot of sense. The supply is coming down. Tariffs are going to increase costs on the new supply side, reducing potential for further increases of new supply over, a pretty decent long period. And it's had pretty good downside protection in an inflationary environment. Typically, it counters that. Rents typically grow with inflation. Inflation is often driven by payroll growth, wage growth, and rent that allows rents to grow in lockstep as well. So there's a lot to like. It's just, again, you can make that statement, but then look at the actual performer for the deal. You got to be buying at a price and financing it to a point of where the cash flow still makes sense and meets the kind of the goals and the thresholds of investors.
I think one of the interesting parts about the current dynamics here is it does look so promising. in like 26, 27, and past 25, but it also does not erase at all like the difficulties and the kind of interesting times that some borrowers are living in, the ways that like maybe the CRE markets have to kind of change the rules in the Excel spreadsheets that are defining what deals make sense to them. So like things are going to get shaky, but like I'm here for it. I'm here for the ride.
Thanks for coming along with us on this wild ride. Good episode of The Gray Report. Make sure you are subscribed to the Gray Capital YouTube channel if you are not already. You get updates with these awesome videos. I think the bell icon will give you a little notification. Leave a comment. We respond. And as mentioned earlier, we got a great newsletter. It's award-winning. It is known as the best multifamily newsletter out there. It's called The Gray Report. You can find it at graycapitalllc.com. All right. Well, we'll catch you on the next episode of The Gray Report. Stay safe.